Hi, Steve Van Metre here, and welcome to your Wednesday night premiere, where we take about 15 minutes every Monday and Wednesday night, trying to make sense of markets that really don't make a whole lot of sense. The Federal Reserve announced this afternoon something that I would say means they're panicking. Investors interpret it as buy stocks into the end of market close. I'm shocked by this. As you can tell, I don't understand it. And I'm going to show you a chart today that says what the Fed is doing is a precursor to major problems, and why at least one cut of the federal funds rate is justified next week. Maybe two. I know. Let's go look at some data first. This is investing.com. This what we're looking at is yesterday's economic calendar. It's worth noting that we kind of already knew this because we looked at the mortgage loan data. And what did we find yesterday? Where there you go. Existing home sales fell by 2.2%, or from 5.5 million to 5.38. See, we already would have known that. Now today, in the data, we got some more evidence that long-term interest rates need to fall. And the weekly mortgage applications fell by almost 12%. The purchase index fell, and the refinance index fell. Now, the refinance index isn't really a big deal unless it's cash out refinances, which about 60% of all refinances are. But the fact that the biggest creator of money in the monetary system is falling, it's great news for bondholders. Let's take a look at the NASDAQ McClellan Summation Index, showing that liquidity is fighting back, trying to, we thought maybe it was going to get down to 300 and break, but market participants are just going to try to keep this thing alive, and they push back as of the last 2 days. So they're doing their part. As far as the agricultural commodity story goes, the USDA has admitted now that the growing season for fall is over. The crops are frozen. What aren't frozen are about to get frozen over the next week. Wow, look at that in Alaska. They're going to see temperatures 90% above normal. That is crazy. But here you can see in the Midwest is going to see, in some parts, temperatures 90% below normal. Now, with crops frozen, this doesn't matter in terms of freezing temperatures. Where it does matter is if you get rain with it, and you see there's no real rain here, but if they start getting snow and or hail, anything that knocks crops over before they're harvested, it would be a problem. In fact, some states reported wind damage where they knocked literally corn stalks over, and apparently you cannot harvest that very easily. Cold weather will stay in the Midwest over the next 14 days, maybe perhaps to the benefit of our farmers. No rain. There are farmers that are reporting that due to the wind, somewhere around 5% of their crops were going to be lost above and beyond what they thought. So that's unfortunate, although it does actually fit right in with our solar minimum view that we're in a solar minimum. You get crazy weather, you get reduced crop yields, even though the USDA says no, there'll be no reduction. It's going to come down to the final weighing. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This drill is not to be construed as recognition or solicitation by selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre, our own personal capacity. Opinions expressed in this video or that one do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. Now, what's interesting when it comes to investors is after the dot-com bubble, people said, well, I learned my lesson. They did. They didn't buy tech stocks until later. And when they lost money in the great financial crisis, okay, well, I've learned my lesson. Next time, I'm going to get out before things go wrong. And I've outlined, for years, all of the warning signs, and especially last Friday, for those of you who took the time to watch the 50-minute video, the warning signs are all over the place. The difference between this time and the last two times is when the sell-off begins is all computer control. We have computers providing liquidity to the market that trade in milliseconds or maybe even faster. We have no human intervention for the most part in this market. And when you start seeing warning signs, well, it means you should do something. Today, the market got a warning sign and it said, buy stocks. Let me show you what the New York Fed said within the last hour of trading. So, statement regarding repurchase operations. The desk has released an update to the scheduled repurchase agreement or repo operations for the current monthly period. Consistent with the most recent FOMC directive, to ensure the supply reserve remains ample even during periods of sharp increases in non-reserve liabilities, and to mitigate the risk of money market pressures that could adversely affect policy implementation, the amount offered in overnight repo operations will increase to at least, keyword, to at least $120 billion. This is going up from $75 billion starting tomorrow. The amount offered for the term repo operations scheduled for the end of the month, there's two more, Thursday and next Tuesday, so tomorrow and next Tuesday, will increase from $35 billion to $45 billion. They have updated this or clarified the $120 billion will run through through November 14th. Some people are saying it's due to Brexit uncertainties. The bottom line is, when the Fed starts to panic, it's a problem. It means bigger problems are coming. Now, we can go back and look at prior instances of repo operations. And if I had previously stated or written that was in the prior to the dot-com bubble, I'm correcting myself. It was prior to the great financial crisis. I want to thank Sven Henrik of Northman Trader, at Northman Trader, who posted the chart of the repo purchase agreements. I assumed they existed, but I didn't know. And thanks to him, I was able to go get it myself. And I overlaid the effective federal funds rate. And you can see, going back to 2003, the Fed was running somewhere between 20 and 40 billion of repo operations. And the market didn't care. It didn't start to care until they lost control. And you can see it popped up to 60 billion. The Fed was forced to cut. So what does that tell you next Wednesday, 1 week from today, what is likely to happen? The Fed is probably going to cut at least 0.25%, maybe 0.5%. And that cooled the repo market off until it exploded. And then the Fed went to zero. And obviously the great financial crisis is the rest of the story. At their peak, they were sitting around $130 billion in overnight repo. I do not know if they did term repos, but it would be included in there if that was. Right now, we were at 200 billion in term repo, or 200 billion in repo operations, and that number is now set to get even bigger. Remember what I said on Friday, for those who took time to watch the video. When will the market care? When overnight repo gets to 300, 400, 500 billion, a trillion? Well, obviously the Fed believes that there's a need for liquidity starting tomorrow of at least 120 billion. Now, that doesn't mean that there is 120 billion of offers coming in tomorrow. We don't know. There could be. But the key is at least, meaning they're set to go above that. It's a huge warning sign. So look at this chart. When the repo operations start to get out of control, the Fed has to cut. So we know they're going to cut to bring short-term interest rates down. We know they have to take the pressure off the monetary system. We know when short-term rates fall, long-term rates go down. But rising repo problems, bad news. And there you go. So again, thanks to Sven Henrik for posting that so I could steal where he got the data from, because I could go poke around the Federal Reserve Web's database and probably not find exactly what I'm looking for. All right, let's go take a look at some charts. So let's take a look at the largest S&P 500 ETF that had a whopping 33.8 million shares traded today, which is pretty abnormally low. I mean, this is, you have to go back to holiday a year ago. Here's Thanksgiving, where the market closed early, and it had more shares traded. It traded 42.8 million. So the market is running out of liquidity. But here you can see, shortly after the Fed announcement, boom, 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 markets loved it when they shouldn't. This should tell investors there is a serious problem. The Fed is losing control of the money markets. They don't know why, and they think more easing will do it. And it's not going to work because the Fed doesn't know what the real problem is. The real problem that you and I know These long-term interest rates are too high. The mortgage or the existing home sales, what did it tell us? Too high. What did the weekly mortgage data tell us? Too high. What is the data tomorrow going to tell us? Probably too high. So we know long-term rates are too high. We know there's a lack of liquidity in the markets. We see that not many shares are being exchanging hands, and the Fed is raising the overnight liquidity needs. Something is wrong. This is not normal. But investors, what did they do? Well, they sold portfolio insurance in the terms of U.S. Treasury securities. So they sold Treasury bonds and continue selling, at least looks like in after hours trading. So that you could see they continued selling that because they kept buying stocks. How does that make any sense? So let's put some of this in perspective. What we know is when there's a downtrend, there's a big increase in volume over the norm. That's stopping volume. And then what happens? Now, sometimes you stop and there's enough. But in this case, and this is totally normal, it can go either way. Sometimes you got to stop and then a move higher. So here you could see, no, that's not a good example. Here you can see a stop and then boom. Here you got to stop and the market then kind of lingers and lets the sellers come in. And we can see this dotted purple line, which is acting as resistance, and sellers came in, but notice lower and lower and lower volume. And then they gap down. Today there was a gap up right back to resistance. Why did the market do it? To see what the selling strength was. And the gap closed, which is excellent news from a market. We want to see that because now the market could either gap down tomorrow, maybe, or even gap back up close to where it was today's high, and that would be totally okay. It's just when it gaps above its prior daily high or gaps below its prior daily low that the market has to clean that up. And we want it to clean up because there's a gap here in TLT, a gap here right back near the former all-time highs, and then there's a big gap right up here near the all-time highs. These gaps will be filled. I think I showed you on the Friday video, if you go back and look at the prior highs, there were tells, there were little clues of gaps that were left open that eventually got filled. So some people are like, oh no, it backed off today. That's okay. It closed the gap. I'd rather it close the gap today to give it a chance to go up tomorrow. So that, and as far as I'm concerned, is pretty good news. Okay, so let's take a look at some things. So quantitative easing was supposed to be bad news for bonds. They should be selling off like crazy. We've got $200 billion in overnight repos. That is effectively quantitative easing. The Fed's at $42 billion of quantitative easing. And we still are seeing buyers come in here, which is a smart money. Why would they want to buy this? Because they knew the Fed is running low on liquidity. And we know that too. Now, how do we know? Because commercial and industrial lending contracted on a 3 and 6 month basis. We know one of the biggest money generators in this economy is not generating the money it needs. We also know the real estate loans are running at a very, very low rate. And based on the data we just saw today, it tells us the data we see next week should show a further slowdown in the amount of mortgage loans, which means interest rates are too high. And if you knew that, what would you do with that information? Well, you'd probably buy bonds is what you would do. So none of this is actually bad today. We do know the markets want to send it higher. Oil prices, or crude oil, actually saw some draws, which is a little bit surprising, although exports did increase and some money flowed into oil and gas producing stocks. And as we already looked at, the broad equity indices that were supposed to be at new all-time highs. Remember, we have 2 rate cuts, $200 billion of overnight repo loans, and $42 billion quantitative easing. Remember, all we heard about new all-time highs. Well, it's not here. And when you look at the volume, when volume falls in an uptrend, it means a downtrend is coming. And if the Fed is panicking, well, it tells you something seriously wrong. Because why would the Fed make this change if nothing was wrong? Why would they do it? Because they know something's wrong. They don't understand what we know is as the economy generates less money because the two big loan generators, one is contracting, the other one's rapidly slowing below trend, the overnight liquidity problems get worse because the monetary system is not generating enough dollars because the economy is not working due to the fact the Fed over tightened. I'll see you Friday. I'm Steve Van Metre. Bye now.